Welcome to Iron Financial, where we help you forge a stronger portfolio by cutting through the market noise. Today we're looking at a real head-scratcher, Ollie's Bargain Outlet. Now, this company just dropped an earnings report that by most measures should have been a home run, but the stock got hammered. So the question is, how can a company be firing on all cylinders and still disappoint Wall Street? Is Ollie's a powerful growth machine being unfairly punished, or are we looking at the first cracks in what might just be a house of cards? We're going to tear this one down to the studs and find out.
All right, let's get right into the numbers. On one side of the coin, you see this massive figure, 16.8% year-over-year revenue growth. I mean, in this retail environment, that's just a monster number. It tells you they're absolutely taking market share. But, and this is the big but, Wall Street's analysts, the so-called experts, they were expecting even more. They missed that target by about 0.5%. And that right there is where the whole story gets complicated. Because sometimes stellar isn't good enough.
And that's the central question we have to answer today, isn't it? Is the market just throwing a tantrum over a tiny, almost meaningless miss? Are they completely ignoring the incredible growth story playing out right in front of them? Or are those small misses the tip of the iceberg, a warning sign of deeper, more structural problems that the big, shiny growth number is trying to hide? To figure that out, we have to build both cases, starting with the bulls.
Okay, let's build the bull case. And I want to be clear, this isn't built on hope or hype. This is a case built on concrete and steel. Hard, undeniable numbers that paint a picture of a company building a fortress. The argument here is simple. Forget the Wall Street noise about a fractional miss and look at the actual engine driving this business forward. They are in a period of what I would call hyper-expansion, and the evidence is just overwhelming when you look at their physical footprint and, more importantly, their customer base.
Let's start with this number right here, 86. That is the number of new stores Ollie's opened in a single fiscal year. Now, to give you some context, their previous all-time record was 50. So this isn't just growth. This is a radical acceleration. They basically floored the gas pedal. And you have to ask why. Well, management is being very clear. They are feasting on the wreckage of weaker retailers. Every time a competitor goes under, a prime piece of real estate opens up and Ollie's is there to snatch it. 86 new beachheads in 1 year, that's a declaration of war on the rest of the industry. They are on the offensive while everyone else is in retreat.
But, opening stores is only half the battle. You can build all the forts you want, but you need a loyal army to defend them. And that brings us to this next number, 17 million. That's how many people are in their Ollie's Army loyalty program. And get this, it grew by 12% last year. That is absolutely critical. It proves they aren't just getting one-time shoppers. They're turning curious customers into a dedicated, repeat business machine. This is the lifeblood of retail. It creates a defensive moat around their business that's incredibly hard for competitors to cross. It shows that their promise of good stuff cheap is building a real, lasting connection with millions of people.
And this isn't happening by accident. Management has actually laid out their battle plan. They call it their long-term growth algorithm. Think of it as a well-oiled machine with 3 key parts. First, you start with that aggressive 10% annual unit growth. That's the 86 stores we just talked about. Second, you layer on top a steady, sustainable 2% growth in your existing stores. That means the whole operation is getting more efficient. And third, you take all the cash that this machine spits out and you use it to buy back your own stock, which juices your earnings per share. You put those 3 pillars together and you have a clear, repeatable formula for delivering mid-teens EPS growth year in and year out. It's a blueprint for building shareholder value.
And if you want to know why they're so confident they can pull this off, just read this quote from their CEO. "Our deal flow is off the charts." That's the core of their competitive advantage. As other retailers die off, Ollie's becomes the #1 phone call for manufacturers who need to get rid of excess inventory. It creates this beautiful, virtuous cycle. More store failures mean Ollie's gets access to better and cheaper goods. Better deals for them mean lower prices for you and me. And lower prices drive more customers, which makes them even more powerful, which funds more store openings. You see, it's a self-reinforcing engine that gets stronger as the retail landscape gets weaker. That, right there, is the bull case.
All right, that's a powerful story. A growth machine, a loyal army, a brilliant strategy. It's compelling, I'll give you that. But a fortress is only as strong as its foundation, and stocks don't drop for no reason. So now it's time to play devil's advocate. Let's grab a magnifying glass and look for the cracks. The bear case isn't about the big, shiny numbers. It's about the little details that might tell a very different story.
Now look at this scorecard. Sure, a 0.5% miss on revenue, you could call that a rounding error. But it's not just one number. Look at the pattern. They missed on revenue. They missed on adjusted earnings per share. And here's the kicker. They guided down for the next fiscal year. That's a trifecta. When a company misses on the past, the present, and the future all in the same report, that sends up a huge red flag. It suggests that management might not have as firm a handle on the business as the bulls think, and that Wall Street's models might actually be too optimistic.
And this is where the bear case really starts to bite. Gross margin. It dropped by 80 basis points. Now, why is that such a big deal? Because it strikes at the very heart of their business model. The whole bull story is that their off-the-charts deal flow lets them offer amazing prices while making great profits. This number questions that. It suggests they might be sacrificing profitability to hit that big sales number. Were they forced to slash prices to move merchandise? Management called it planned price investments, but that's just corporate jargon for cutting prices. The real question is, are they actually earning this growth, or are they just buying it at a lower and lower profit?
And if you read the fine print from their conference call, you start to see more signs of stress. They blamed severe winter weather, which, every retailer does. But the more worrying part was the admission that their brand new stores were performing slightly below plan. Uh-oh. When your entire story is about opening a record number of stores, you absolutely need those new stores to be productive right out of the gate. The fact that they're already lagging is a crack in the execution. And then you see this. Inventories ballooned by 18%, way faster than their sales grew. A skeptic looks at that and wonders if they're struggling to move product. Is the rapid expansion leading to sloppy operational control? The seams might be starting to show.
And then you find this. For many investors, this is the nail in the coffin. A couple of weeks after this shaky report, a filing pops up showing that the chief financial officer himself was selling shares. I mean, the timing couldn't be worse, the optics are terrible, and the question it raises is immediate and obvious. What does he know that we don't? If the future is as bright as the CEO claims, why is the guy in charge of the money cashing out? This is the kind of thing that can seriously spook the market.
Okay, hold on. Let's pause right there, because this is a classic trap, and it's where you have to separate fear from fact. If you actually look at the filing, you'll see the transaction was marked with a code F. Now, this is not a discretionary sale where the CFO decided to hit the sell button. A code F transaction is completely automated. It means shares were automatically sold by the company for him to cover the income taxes he owed when his stock options vested. It's the equivalent of having taxes withheld from your paycheck. It tells you absolutely nothing about his confidence in the company. It's just noise, not a signal of trouble.
Okay, fine. So the insider sale was a red herring, a misunderstanding. Fair enough. But that doesn't just erase the other cracks we found. The margin pressure is real. The inventory buildup is real. The new stores underperforming, even slightly, is real. So it all boils down to this one critical question. Can they keep up this breakneck pace of expansion without the whole structure starting to crumble under its own weight? Can they really handle this much heavy lifting all at once? And to answer that question, you have to look at the bedrock. This is where the bear case, with its focus on minor operational friction, runs smack into a wall of financial granite. The reason OLLIs can handle the strain of this expansion, the reason they can do all this heavy lifting, is because the foundation of this company is unbelievably solid. We need to shift our focus from the day-to-day income statement to the long-term balance sheet, because that's where true corporate strength is forged.
Just look at this number, $428.7 million. That's how much cash and short-term investments they had just sitting there at the end of the year. This isn't just a rainy day fund. It is a strategic weapon. This is the war chest that lets them pounce on those off-the-charts deals when they pop up. It means they can fund their entire expansion plan without ever having to go to a bank, hat in hand. It gives them a level of flexibility and power that most retailers can only dream of.
And this is the knockout blow. Zero. That is the amount of money they have borrowed against their main line of credit. For all intents and purposes, this company is debt-free. Think about that. In an industry where so many iconic brands are drowning in debt, just struggling to make their interest payments, OLLI's has zero. None of that baggage. This is the ultimate structural advantage. It means every single dollar of profit they make can be reinvested directly into making the business stronger, not siphoned off to pay bankers.
And this brings us right back to our core principle here at Iron Financial. A strong balance sheet isn't just a nice to have, it's the very foundation that supports everything else. All those concerns the bears have, the margin pressure, the inventory, the cost of new stores, they're all manageable precisely because of this foundation. A company loaded with debt might crack under that strain, but OLLI's has the financial shock absorbers to handle it. Their fortress balance sheet gives them the stability to execute their aggressive plan and to weather any temporary storms. This is not a house of cards. It's a fortress built on bedrock.
So, we've laid it all out. We've built the bull's fortress of growth, and we've examined every crack the bears could find. Now it's time to weigh the evidence and forge a final verdict. Is the market's reaction an opportunity to buy a solid company on sale, or is it a trap waiting to spring on unsuspecting investors?
So let's put it all on the table one last time. The bull case is all about the big picture, the structural strengths, record-shattering growth, a market position that gets stronger every day, and a balance sheet that is, frankly, a fortress. The bear case is focused on the here and now, the tactical friction, the small, technical misses against analyst numbers, the squeeze on margins, and the very real risks that come with trying to grow this fast.
Okay, here's the verdict from our analysis. The evidence strongly suggests that the core growth story here is structurally sound. The fears of a collapse seem way overblown. The so-called misses are just statistical noise compared to the signal of nearly 17% growth. And that fortress balance sheet, well, it provides a huge margin of safety that can absorb these kinds of operational bumps. But, and this is important, the bears are right about one thing. The key risk here is execution. The entire success of this story now hinges on management's ability to handle the insane logistics of this rollout. The structure is solid, but it's an active and very ambitious construction site. It needs to be monitored closely.
And that really leaves us with the final question, the one you need to answer for yourself. The debate isn't really about if OLLIs will grow. They will. The real question is how well management can continue to do all the heavy lifting required to build this retail empire without dropping anything. This is a company in the middle of a massive construction project, and that comes with noise, dust, and the potential for delays. So you have to ask yourself, is your portfolio built to handle that kind of project? Is it forged to withstand that kind of short-term volatility for potentially massive long-term payoff? That's the work you have to do. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.